My name is Anil Sarin. Myself and my team of fund managers and analysts have been managing the PMS and the other products of Centrum Asset Management for the last 9 years. I have around 26 years of experience with different mutual funds and VC firms in the past, and my team is highly qualified and highly experienced. Our performance in the past many years has been quite satisfactory. As you can see over here, over the last 7 years, our multi-cap product called Wealth Creator, which has a large cap focus, has been able to deliver 15% compounded returns over the last 7 years compared to the index, which was 11%. Our small and mid-cap product called DV1 has delivered a 7-year compounding result of 15.6%, which is much higher than the benchmarks. Our recent products are Build to Last, also called BTL, and Good to Great, also called G2G, which have both delivered significant outperformance compared to their benchmarks in their very recent and very short history of time. Taking it on a month-by-month basis, Good to Great has been able to deliver outperform, as you can see over here, significant alpha, significant outperformance over the benchmark in its very short history. What we have seen in the recent past is one of the sharpest falls in the markets anywhere in the world, including in India. But the good news is that in the US, the authorities have responded with a great deal of speed and with enormous amount of resources, both on the monetary as well as on the fiscal side. As such, the bounce back from the steep decline has also been equally fast. And while we don't know about the future, but going by the way the market is behaving and going by the way the authorities in different parts of the world are willing to support the market, we feel that the bottom for the market has already been made, and we look forward to the rest of the year 2020 to be a kind of a trading market where the markets will go within a range up and down based on how the COVID results, sort of COVID and the aftermath of COVID results pan out. We feel this is a good time for investors to increase their equity allocation because history has supported the notion of investing after a crisis. Subsequent returns have been better for those people who have invested immediately after the crisis. We recommend a barbell approach where 50% of the money that investors wish to deploy in the equity markets should go towards large cap and 50% should go towards mid and small caps. For the large caps, we have a product called Build to Last or BTL, and I would request my colleague Abhishek Anand to talk about the BTL portfolio. Over to Abhishek.
Thank you, Anil. Thank you, Anil. Our large cap portfolio, we call it Build to Last. Today, investors, if you look at large cap portfolio, if you want to participate, you have two options. One is exchange traded fund, and the other is mutual fund large cap portfolios or a large cap PMS or AIF. Now, in case of exchange traded fund, what you see is you have participation of all the stocks within the index. So you have an inclusion risk. What do we mean by inclusion risk is that by virtue of you participating in all the stocks within the index, you have certain weaker names also getting included in that. As a result, you get only participation to the extent of index performance. On the other side, when you participate in the large cap via a mutual fund or let's say an AIF or a PMS, you have something called as exclusion risk. Now, in today's environment and historically also, you have seen a lot of sector rotations and stock rotations. Even in the recent past few years, banking as a sector has been doing extremely well. The past laggards like Hindustan Unilever or Reliance, recent past has done phenomenally well in terms of generating returns. So this, we call it as sector rotation or stock rotation, which has to be adequately captured in order to keep outperforming the benchmark within the large cap. And these two aspects, we try and capture it very well in our Build to Last strategy. Now, if you look at top 100 companies, in our case, which is Nifty 100, the way the construct of the index is like this. So almost 20 number of stocks have 70% weight, and the long tail, which is 80 number of stocks where the weightages are less than 1% individually at stock level, you have just 30% weight. The way we construct this is that of these 20 heavyweight number of stocks, we have adequate exposure. So thereby it gives us that benefit of all the heavyweight exposure to important sectors or variety of sectors. And from the tail of 80 number of stocks, we do our fundamental analysis and select 8-10 stocks. So therefore it gives you 28-29 stock portfolio with adequate exposure to heavyweights. So tomorrow, if there is any sector rotation or stock rotation, we have through these heavyweight exposure a greater degree of or the ability to capture these swings. We have been running this since last 8-9 months, and the results are encouraging. Month by month, most of the months we have seen that we are able to do better than benchmark. Even in the case of March 2020, which has been one of the most volatile months, we delivered a little better than benchmark. And the way we are constructing this by having this heavyweight mimicking and cherry picking from the tail and giving you that 8-10 quality names, we feel that the portfolio has ability of generating better than benchmark returns, and over a longer period of time giving you that alpha possibility in a far better manner than an ETF or a large cap mutual fund or an AIF if they're not able to swiftly move, which is a very difficult task in our opinion. So this in essence is our build to last strategy, large cap. Now I hand it over to Anil to explain our mid cap strategy. Thank you.
The good to great portfolio is a mid-cap and small-cap portfolio which aims to deliver significant outperformance over the mid-cap and small-cap indexes. How do we do that? We do that with the help of our EDGE framework. EDGE is EDGE, E for earnings quality, D for deep dive research, G for governance, and E for execution. This EDGE framework allows us to pick leaders in mid caps and small caps, and which have common characteristics like dominance in their industry, high return on equity, strong earnings growth, and cheaper valuation. The way we invest while creating the good to great portfolio is we divide it into two parts. 50% of the portfolio, which is essentially a 20 stock portfolio. So 50% of the stocks are so-called high quality stocks, which are well-known, well-regarded names, which are also valued quite well, but which give you the benefit of lesser volatility during tough times. Names such as Muthoot, Trent, VIP, etc. These form part of the high quality part of the portfolio. And then there is a high opportunity part of the portfolio, which is 50%, which have names like Granules, Vaibhav, APL Apollo, Polycab, Max India Limited, etc., which have a combination of high return on equity, high growth, but they have cheaper valuations. But because they are lesser known, they tend to be more volatile. We feel by mixing them up together in a 50-50 kind of fashion, we are able to give you the benefit of both high quality as well as the growth which is inherent in high opportunity. And the proof of the pudding we have already shown you in a relatively short history of around 8 months. The good to great portfolio has been able to significantly outperform the index. And this gives us the confidence that once the COVID-related uncertainty abates, in the coming years, we shall be able to deliver very strong and significant returns for our investors in the years to come. Now, coming back to our strategy, we feel that this is a time to be investing more in equity and reducing from other asset classes. We recommend that you do it in 3 tranches. 1/3 now, 1/3 after 2 months, and the last 1/3 after 4 months from now. And you should invest in a barbell fashion. 50% of each tranche should go towards build to last, and the other 50% should go to good to great. Using this staggered approach to investing and dividing between large cap and mid cap strategies, which have really done well in their recent history, we expect the investors should be able to meet their financial objectives. So with this, we thank PMS Bazaar once again for giving us this opportunity, and we wish our investors happy investing in the years to come. Thank you.